Business of Property podcast. I'm Simon, and I've been investing in property for over 20 years. And if you're an active landlord or planning your next property investment, this podcast is for you. Last week's episode was all about why you might or might not want to move an existing rental property from being owned in your personal name or personal names to being owned by a limited company. This week, I'm going to follow up on that and run through the financial implications of making such a move. First, let me set the before scene. This is based on a real property with just some minor adjustments, but the figures should be quite realistic, I think. This property was purchased in 2017 for about £310,000. It's since been remortgaged to extract funds, and we're going to work on that being in 2020, at which point it was valued at £380,000. And that's relevant, or the date is relevant, because we're now looking at 5 years later than that, and this is sort of the remortgaging point. The previous remortgage was to a 75% loan to value, so we have currently a £285,000 mortgage on this property in this situation. And rent is currently £1,800 a month, which is a little bit below market value, but you've got long-term tenants in place and you have increased rents, but they have still fallen behind a little bit. So currently this is doing okay, but as I said, it needs a remortgage. So if that happened instead of selling it, which is sort of the two possibilities that we're looking at, then you'd have an after-tax profit of only £62 per month. And this is, of course, because of the various things I mentioned in the last episode around Section 24 and the tax implications of that with the higher interest rates that we'd be looking at following the remortgage. So that's really not a great return considering how much equity is actually tied up in this property. So let's see if we can keep it as a revenue generating asset, but increase the profit by moving it to a limited company. Now, as I said last week, moving in this sense actually means selling it and buying it again. Because you and your limited company are two completely separate entities. So you as a person has to sell it and you as a limited company has to buy it. So let's look at selling first. It's now, quite a few years later, worth about £450,000. So 450,000 minus 310,000 gives us a basic gain of £140,000. But we need to pay a solicitor to handle the sale. I'm going to allow £700 for that. Then we have to pay capital gains tax. From our £140,000 gain, we get to subtract our solicitor cost and the solicitor cost when we were buying it and the stamp duty when we bought it, and also the standard sort of £3,000 capital gains tax allowance. So all in, that gives us £120,700 that we have to pay tax on. Now, all of these scenarios, all of these assumptions are working on being a higher rate taxpayer. So for capital gains tax, that means you're looking at 24% tax rate, which of course means that you've got almost £29,000 of tax to pay on this sale in capital gains tax. So in summary, selling has cost us just over £29,500 once we've added in solicitor costs and the tax. But none of this directly tells us how much cash we walk away with. For that, we need to take our sale price of £450,000 and subtract our mortgage, which we have to repay, and our sales costs, and the capital gains tax we have to pay. And working all that out, we end up with about £135,000. Now that's half the process. Now our limited company needs to buy the property. As I said already, the purchase price is £450,000, and we're going to take out a new 75% loan-to-value mortgage. And rather than just maintaining the same mortgage level, we're mortgaging up to the 75% of the the current purchase price, the new valuation, in order to minimize the amount of cash that we need to find for this process. We still have to pay all the stamp duty though, which is a whopping £35,000. And due to our £337,000 mortgage, we also need to find or provide £112,500 as a deposit. Unfortunately, there are also £11,000 of mortgage and solicitor fees to add in as well. All in, our limited company needs to find almost £159,000 in order to actually complete this purchase. You might recall we only walked away from the selling part of this process with £135,000 in cash. So to complete the process of moving the property to a limited company, we have to find an extra £24,000. And we've reduced the equity that's held within this property by another £52,000 because we've now got that larger mortgage on it. Effectively, the process has cost £76,000. Now, let's see what we've got to show for it. So this is looking at the after situation of making this move. Well, we've still got a higher mortgage rate because we are looking at the current world, and on a larger mortgage as well, because we did take the option to reduce the amount of cash we have to put in, and hence we're now looking at paying a larger mortgage rate on a larger mortgage amount. So that's not going to help our profit. However, even allowing for that, the after-tax profit in the limited company is £2,500 a year, or £208 per month. Now, that is definitely more than we had from the property outside the limited company. But I didn't allow for the higher running costs of a company, things like an accountant for starters. Now, you may already be paying an accountant. You might have other properties in your limited company that spread the cost as well, so that could be another mitigating factor there. But if you don't, or you aren't, it would likely push our after-tax profit down to about £1,800 a year. Maybe you think that's unfair of me to include that. But what if you want to take profit out of the company so you can, actually spend it? Well, in reality, you'd probably have some loan capital it can repay you, although the official answer is that you'd pay dividends and dividend tax. If you did that, from our £2,500 a year of profit, only £1,700 would actually reach our pocket. That's just £142 per month. So after all this effort, we're making an extra £80 per month. Just in case you're curious, that's about 79 years to cover the £76,000 that it cost us to actually move the property in the first place. Maybe I'm being too pessimistic in this scenario. What if we don't need paying ourselves for spending money at the moment? And we don't need an accountant? And we keep all the extra profit in the company? Well, that's still 43 years to make up the moving costs. This is obviously just one example, and you could improve it. You could put more cash in and reduce the company's mortgage, for example. That would improve your cash flow going forwards, but you're still spending the money in one form or another. So if you're a landlord who's feeling stuck with a property that now only makes you a few pounds a month after tax, what are you supposed to do? As I've said before, this is a podcast. It is not advice. So don't go out and do exactly what I'm about to suggest, but it's some ideas for you to consider and think about. One landlord I know is selling their existing personally owned property. But not to get out of property though. They still believe in property as an investment, but they can't justify holding these personally owned properties when the actual cash flow from them is so low. And not this particular landlord, but some other landlords I know have actually got negative cash flow after tax. So there are some even worse situations out there. So if they're not getting out of property, what are they doing? Well, they're using the capital released to find new deals that they can then add value to again. In this particular example, they're using a buy, refurbish, refinance, rent approach to maximize the cash that's released and they can maintain going forwards. Or if your personal portfolio is a bit larger, you could potentially sell some and use the money to pay off mortgages on others, reducing the Section 24 effect. And you might, I think, be surprised how much that can improve your after-tax cash, the actual money that you get to walk away with out of this process and the property portfolio that you have, simply by reducing that mortgage cost element and hence not actually reducing your tax, but the two put together can really actually improve your profit. So anyway, maybe that's a future topic for a future episode to try and give you an idea of how those sums actually work. For today, though, I hope you found this interesting and perhaps eye-opening in terms of some of the numbers that might be involved. Thank you for listening, and I look forward to speaking to you again next time.